Can you really flip houses with no money? Everybody online says you can flip houses with no money. Is that hype or is that real? I have flipped over 1,000 houses, and here's the truth about doing it without using your own money. In this video, I'm going to show you the exact ways deals get done with little or none of your own money. And the catch, most people don't mention. By the end of this video, you're going to know exactly how flipping a house without your own money actually works, and whether it's realistic for you. So here's the myth and the reality of flipping houses with no money. I get asked all the time, Glenn, can you really flip a house with no money? And the answer is yes, but at the closing table, the seller's going to have their hand out looking for what? Money. They're selling their house to get the cash out of that property. So there has to be money in the transaction. The good news is it doesn't have to come from you directly. Now, even better news is you're already used to doing this. I don't have to train you at all. Have you ever bought a car using a loan? You ever bought anything using a loan? You ever bought a house using a mortgage? You ever used a credit card? Well, if you have already done this technique. It's called OPM, or other people's money. You use other people's money to purchase something now and you pay for it at a later date. That's exactly what you're doing as a real estate investor. The confusing part is, as a real estate investor, we think, well, to be an investor, I have to have cash to be an investor. Well, because of the way this investment is structured, you don't actually have to have your own cash. You can borrow other people's money. Well, they'll get money on their investment. Then you can improve the property, sell it for more money, make money on your investment without using any of your own money. It's a beautiful thing once you know how to use it. And the truth is, most successful house flippers, whether you're doing 1 or 2 a year or 100 a year like I am, are always using other people's money. It just makes more sense by allowing you to do more deals and not be cash flow constrained. So where can you borrow this money from? That's the big question. Well, I'm going to recommend looking at the easiest source you can go after, and that's hard money lenders. Hard money lenders is a group of people that pool their money together and they loan money to people at a short term for a higher risk on house flipping. Now, what does that look like? Well, they will typically loan 80% of the purchase price of a piece of property. So for easy math, if you had a $100,000 purchase price on a piece of property, they'll loan you $80,000 on that property. Now, that still leaves $20,000 that you don't have in the deal, right? We have to figure out how to cover that. We call that gap funding. I'm going to cover that in just a minute. But you also have the renovation costs you have to cover. Because remember, you're flipping this house. So let's say, for argument's sake, that you paid $100,000 for this house. The hard money lender gives you $80,000 for the purchase price, but Glenn, I need $50,000 for the renovation costs. You know, that same hard money lender will actually loan you up to 100% of the renovation costs. Now, they do that in draws throughout the job, so they don't just give you a chunk up front, but that's a way you can get the deal done. Now, how do you make up the $20,000? Well, I talk a lot about it on my channel. You can look at a lot of videos here that talks about it, but we call that gap funding. And gap funding can be covered by a wide variety of things. Number one, I want you to look inward. Where else in your life do you have access to money that you might not be thinking about? Do you have a HELOC, a home equity line of credit? Do you have a line of credit on anything? Maybe an investment property you have. Did you know you can borrow against your 401k if you have a 401k? Usually up to $50,000 you can borrow on a 401k, and you're paying interest back to yourself, so it's a win-win situation. You can borrow money against a cash value on a whole life policy. Again, you're paying interest back to yourself, so it's a win-win for that scenario as well. Or you could borrow against an IRA, you could borrow against an investment portfolio. You know, there are ways you can get access to money. You could even use credit cards if you want to, do cash advances, and if you get really clever, you could use 0% credit cards and borrow money against that at 0% to cover that $20,000 gap that you're missing. That's a way to do 100% of the deal without ever using any of your own money. I actually train on borrowing 110% of your deal. Now, this sounds exciting. Stand by and let me tell you why. When you do a flip, you're going to have cash flowing out the door faster than you've probably ever seen in your life before, because you're buying a house, you're paying contractors, you're paying interest payments to a lender, and you're paying for just the regular maintenance of owning a house. So cash can pour out of the door. So sometimes when people borrow just enough to cover the purchase price and the renovations, they are now left with having to cover the day-to-day cash flow in their lives during this flip. How do you cover that? Well, I suggest a third way. When you borrow money from yourself, like we just talked about, borrow another $10,000 to cover those types of costs. That way you're not cash flow constrained during your flip. Now you say, okay, Glenn, that all sounds great, but I don't have access to a 401k, I don't have a HELOC, I don't have credit cards with that kind of money on it. Am I stuck? Can I not flip a house using other people's money? The answer is, you're not stuck at all. I want you to look towards a private lender. A private lender is an individual that just wants to get a return on their money. Usually it's a family or friend, or a family or friend of a family or friend inside your circle that says, listen, I have some money sitting in the bank that's just sitting there. I'd like to earn 10% or 15% or 12%. Whatever you negotiate is the rate before you ask me. So that's up to you. But you want to find those people that will loan you that $30,000 we just talked about. Now, we have a very special way that we do it and train on it. Inside of our site, we go over in detail how you can do that. So just make sure you spend some time on our site and look up private lenders and how we structure that. But if you can tell them, hey, listen, do you have a home equity line of credit? Because they can use other people's money to loan you money on your deal. You know, if their HELOC only charges them 4% interest and you're going to pay them 14% in interest for their money, aren't they making 10% on money that's not even theirs? How beautiful is that? They're using other people's money to loan you money. So again, I want you to be creative through this entire process. So they also may have just cash sitting around that they want to put to work. If you do this at a small scale and start with private lenders in a small amount of money and give them a promissory note so they're protected by the piece of property, they could also be listed as additional insured on your insurance policy so they're protected. Once you're successful in that flip and you pay them back plus interest and they realize they just made 10 times what they can make in a bank, they're going to get pretty excited about it and probably want to loan you more money. And the next time a deal comes up, maybe you don't have to go for any hard money at all. Maybe this time they loan you the full amount, the 110% themselves. That's how Amber and I still flip over 100 houses a year. We've raised over $10 million with a handful of private lenders, just average everyday folks that have money they want to loan, get higher rates of return, and be in the real estate investing game without taking all the risk as the flipper. Now here's two other ways that you can flip a house maybe you haven't thought about. One, you can partner with somebody. So let's say that you are willing to provide the sweat equity. You'll find the deal, you'll manage the construction, you'll manage the buy process, the sale process, and everything. And you have someone else who says, look I've got $200,000 sitting here that I'm willing to invest with you. You be the sweat equity partner, I'll be the financial partner, and then you'll split the profit on the deal. Well, Glenn, what's the profit going to be? Again, whatever you agree to with your partner. So you can partner on deals to get the deal done. That's one way you can do it. How about if you did what's called a joint venture with the seller? Hear me on this one. This may be something you've never heard before. What if you find a seller who has a house that needs a little bit of repair, nothing major, a little bit of repair, and they're not living in the house, and you say, look, I am very willing to give you your asking price on this house, but I want to partner with you through this deal. And here's how I'm going to do it. I will give you the, let's say, $100,000 for your house. You come in and do all the renovation costs for it. You handle the sales process. You do everything that needs to be done. The seller sits back and waits for you to finish, and then you sell the house, and when you sell the house, you pay them the $100,000 and you keep the difference. Now you've brought the seller in as a partner with you. It's called a joint venture with a seller. Yes, there's special paperwork. Yes, we can help you with all that. That's not really the time to go into this video, but there's a lot of ways that you can be creative when you're financing a deal that doesn't require any of your own money. And even in that scenario, if you had to cover the renovation costs yourself, again, use your HELOC, use a private lender, use everything we just talked about to make sure the deal doesn't have any of your own money or very little of your own money in the deal. You know, having confidence and having a clear plan always attracts money. And deals that you buy at the deepest discount, those always attract money, because hard money lenders, they're really concerned about how protected am I in the deal. If you buy that deal so cheap that you have built-in equity, they can loan you money on that deal and say, even if this person defaults, I can still sell that house as is and get my money back plus some profit. So the deeper you buy the house, the more financing options you're going to have. Now, you've heard me throw around a lot of big interest rates like 10%, 12%, 15%, hard money lenders, different percentages. You've heard me throw around some different numbers here today. But I want you to understand, you'll start at a certain number. I started my first hard money lenders at 4 points, which was 4% of the amount of the loan, plus 14% APR. Yes, it was expensive, but I was brand new and I had to get some private investors under my belt. Now we just pay a flat 10 or 12% to our private investors APR with no points. because we've established credibility and established a track record of being someone they can count on and rely on. The better you are at your business, the cheaper you'll be able to get your money for. Flipping houses with no money requires you to be laser focused on the right kind of properties to buy so you can use other people's money. Go watch my next video, The Crucial Step New Investors Always Miss, where I'm going to show you how to build out the exact buy box you should be focused on, because once you have the right buy box, I promise you the money will come. Go watch that training right now. The link is in the description below.